Morning, everyone. Welcome to the morning kappa at 8 on a Wednesday. I'm here to present the midweek futures traders technical brief. We are on week 5, 2025. This is the table whereby we observe the most popular products traded by traders. So there are some significant changes in the table, mainly due to the movement from a neutral positions for some of the products. The Dow Jones and the Nikkei 225 broke out from a neutral position and now trading on positive setup. What is really outstanding here is the performance of the Nasdaq and the S&P, which has been charting new highs based on the positive positive setup. But currently, there are some headwinds, and also there are some resistance at the higher end. Afterwards, we will have a look at how we can tackle this. We have also corn and also soybean, which has been trading relatively on a positive note, has now turned negative. And crude oil yesterday had a spike to close to $79 a barrel, but it remains to be neutral in the setup. We will also later see what we can do with that setup. Moving ahead to our popular product, FCPO. We have seen the momentum on palm oil gaining strength, and but the recent week there was some profit taking, and prices have dropped to near its weekly low. There is a concern on weakening demand and also an increasing supply of Malaysian palm oil. Exports also declined 9.2% during the July period, first to the 25 days. And this is basically due to reduced buying from China, the Middle East, and also Europe. Here we look at the US commitment of traders indices. For the S&P 500, it registered a decrease of 13,000 of short position. Both the Dow Jones and Nasdaq also saw short positions trimmed by 3,000 and 12,000 respectively. This is also an indication that some of the shorts have decided to quit this position due to the strong setups that we have seen in most of the US indexes. So we focus on the Nasdaq. This is the MNQ September 2025. Basically, the news that's been affecting the movement is the US trade policy remains to be a major point of uncertainty for investors and companies, as Trump's self-imposed August 1st deadline for many countries to reach agreement with the White House approaches tomorrow. Analysts on average expected S&P 500 to report a 6.7% increase in earnings for the second quarter, with big tech driving much of that gain. However, a series of downbeat earnings will weigh on the uptrend momentum, and I think we are already seeing this happening. So what can we do now? So basically, we are looking at a short-term setup which is negative, and the current price is 23474, and the reference price we are looking at is 23520, which will give us a potential profit at 23405 for a value of $230 and a potential loss price of above 23595, and giving us a value of potential loss of USD 150. Moving ahead, we look at energies, as I mentioned, here we see that the crude oil commitment of traders saw long positions being reduced, and the natural gas also had similar actions. So I've also imputed the latest from yesterday, the movement that I mentioned in the beginning. But however, as we can see, there is still a resistance at around $70 a barrel. And this move has basically been impacted by the news that Trump mentioned that Russia has about 10 to 12 days to agree to a ceasefire or face potential secondary sanctions, which shortened the 50-day deadline he suggested earlier in the month. Concerns about the possibility of tighter global oil supplies and also the impact of a triple-digit tariff on Russian oil. And given that significant scale of Russian exports and limited OPEC spare capacity, this could potentially lead to a shock. So this spike is all due to that news which flowed in the past one day. So for this, because of the neutral nature of the chart setup, so we are looking at negative action. So at current price is 69.27, and the reference price is at 67.80, and this would give us a potential profit of USD 240 US dollar at the price of 65.40, and potential loss price which is above the 70.20, and the value of the potential loss is also 240 US dollar. So this is all I have. I'll pass on to Joseph. Thank you.
Hey, morning everyone. Welcome back to our morning cup at 8, and thank you, Vincent, on the futures weekly technical setup update. So looking at the Hang Seng Index, we have traded for 2 days so far this week. What we do see is that Monday and Tuesday, the Hang Seng momentum have slightly moderated. You can see that the index is hovering sideways right now. Nevertheless, a very strong support have established above the 23,000 point level. I think as long as there's a pullback and Hang Seng stay above the 23,000, right, overall technical setup is deemed remains as bullish. Yesterday night, what we do see is that the HXC have a very strong pullback towards the 20 days moving average, but hence this morning, right, the Hong Kong market would have a slightly negative opening, but nevertheless, overall still remains a bullish bias on the Hong Kong market. We remains a bullish bias on the Hang Seng Index futures. Right. This afternoon, good news. We're going to have a look at the market across the US, Hong Kong, as well as Malaysia. Together, I have Aiman with myself. Right. So it's a very rare that two analysts that we have sessions together in one event. So do join us this afternoon to look at the market together, 1 p.m. Right. So register your attendance at the link provided at the Facebook afterwards. So looking at the Hong Kong market, nothing much change on the watch list. But this morning I've added two counters that I think interesting. Firstly, the King D, right? And also secondly, the AIA. So before I go into these two counters, just to recap, another one more counter which we have published reports, I think 2 or 3 weeks back, And this is the semiconductor manufacturing of China, which is SMIC. Right, look at the volume profile. You can see that the SMIC have formed a very strong support at 46.50, right, and it all the way to the 41. So this 46 to 41 is a very strong support zone for SMIC. Now, as what we can see yesterday or this week is that sentiment have a little bit cautious, and some counters resort to profit taking. Right, in the event that SMIC have a pullback, I do think that this 46.50 and 41 level is a very good level to look at in the event that there is corrections for SMIC. Now, on the other hand, we can see that the overall setup right now remains bullish. You can actually opt to momentum trades on the SMIC as well. Should the momentum follow throughs, right, it should climb towards 58 and 67. So right now, the question is where will be the interim support? Is it 52, 46, or 41? Yeah, so these are three levels that I've drafted for you to actually look at. So as for this morning, King D International Software have a breakout from the 17 Hong Kong dollar resistance. So after the breakout, it should climb towards 18 and followed by 19 Hong Kong dollar. Downside support is at 15.50 cents. Now, King D basically in their business of cloud services together with ERP. Now, secondly, we have the AIA Group, 1299. I think everyone's quite familiar with AIA. So you can see that the AIA have a break past 73 Hong Kong dollar, and after breakout, it should move towards 80 and followed by 85. Downside support is 67 and 50 cents. So looking at AIA, the chart, right? This is where makes things looks interesting. All right, that was a very high volume on that particular day in somewhere in the mid-June, and ever since then, right now the share price have climbed above this level, right? So this volume, right, as of right now, we can perceive is as a buying volume instead of a selling volume. Okay, so this morning we'll be looking at two breakout counters. Firstly, the King D 268 and followed by AIA Group 1299. So as for XXXP, right, market is moving sideways as well as the S&P as well. So market is paying attention to the coming Fed meeting on the interest rate decisions. Secondly, we're approaching the 1st August. So I think these 2 days market will be more likely moving sideways. But as of the news right now, the US Commerce Secretary have mentioned that the tariff will be happened on the 1st of August. Okay, and so these are some of the stocks that we have on the US watch list. You can take it as a reference. And this week we'll be paying attention to towards the leader of the sector, such as constructions, the consumer properties, as well as the utility. So I think these four sectors remains garnered attentions of the market right now. As for the FKRI, it remains a sideways movement, consolidating below the 1550. We still stick to a bearish bias until it break out from 1550. FCPO have staged a very strong rebound yesterday at the 4002. And on the downside, all right, our stop loss point remains at the 4001. So as long as the FCPO stay above the 4001, we'll keep the bullish bias intact. So this afternoon, right, 1 p.m., we're going to have me, myself, together with Aiman, we'll be looking at the market together from a technical angle, and we're going to discuss the US stocks, Hong Kong stocks, as well as Malaysia stocks. So for trading stocks this morning, we'll be looking at Petronas Chemicals. They have break past their 3.75 ringgit resistance on the back of high volume. Now after breakout, PChem will test that resistance at 4 ringgit, followed by 4 ringgit 25 cents. Downside support is marked at 3 ringgit 50 cents. Secondly, we have Pavilion Reit. Reit have break past resistance at 1 ringgit 73 cents. Eyeing to test up 1 ringgit 80 cents, followed by 1 ringgit 90 cents. Downside support is marked at 1 ringgit and 65 cents. So we have two breakout stock this morning. The PChem as well as pavilion REIT. So I stop here and pass on to Nabil on the Bursa report. Thank you.
Right. Hello, everyone. Good morning. So I have a Bursa Malaysia results note for the second quarter ended June. So Bursa's first half 25 results met expectations. The second quarter net profit stood at 57 million ringgit. This was down 29% year-on-year and down 17% quarter-on-quarter. And this actually came in within the unofficial range that we had provided in our results preview note last week. All in the first half 25 net profit stood at 125 million ringgit, or down 19% year-on-year. Total revenue was an 8% drop, as expected due to the softer securities ADV readings. OPEX, on the other hand, creeped up 7% year-on-year, and so the cost-to-income ratio jumped to 53% from 46% in first half 24. An interim DPS of 14 cent was declared, which represents a 90% payout ratio, and this compares to the 18% interim that was declared in first half of last year, which then represented a 94% payout ratio. So for the first half of the year, the Bursa's PBT of 167 million ringgit is slightly tracking below management's target range of 369 to 408 million ringgit. Interestingly, management chose to keep this target range unchanged, as it sees some scope for an securities ADV rebound in the second half of 25. So several key reasons for this. The first being that your trade uncertainties, which carried over from the second quarter, should gradually begin to dissipate, especially as we near the deadline for the tariff negotiations in 2 days' time. Secondly, Vietnam's OPR cut and potential Fed funds rate cuts ahead should be more accommodative for risk-on behavior. And lastly, local equities are trading at undemanding valuations. Bursa had also recently launched its Vibrancy Initiative program, which is part of a list of efforts that Bursa is working on to enhance market vibrancy and liquidity. On the derivatives front, the exchange will gradually introduce more and more equity-based products with lower contract values to increase the depth of the derivatives market. So do watch that space. In terms of guidance, not much was provided other than a full year cost-to-income ratio range of about 53% and non-trading revenue growth of 5 to 7%. This is on top of the PBT target earlier. And lastly, we don't expect Bursa to pay out another round of special dividends. Management had mentioned in the briefing yesterday that they will likely require a higher degree of cash preservation this year, as it is anticipating heavy capex for its core system upgrades, which should commence next year. So all in, we made no changes to our forecasts and no changes to our target price, as the results were in line. To a certain extent, we do agree with management's expectations of an ADV rebound, though we don't expect the uplift to be that material, nor will it be anything that is not already in the price, we think. So yeah, we are keeping our neutral call with a 8 ringgit 05 cent target price. So that's all from me. On to you, Chair. Thanks.
Okay, thanks, Nabil. So I'll move on to IGB rate result. So we're downgrading the stock to neutral from a buy, target price unchanged at 2 ringgit 60 cents. So basically, first half results met our expectation. Looking at the results, year-on-year, first half revenue rose 6%, driven by solid rental reversion from a lower base, as the REIT was undergoing a major reconfiguration in the previous year. In terms of margin, NPI margin, first half NPI margin expanded by 1.5 percentage point, supported by operating leverage from higher revenue. Q-on-Q wise, second quarter revenue declined 7% due to softer seasonality in the absence of festive periods, and consequently, second quarter core profit fell 12% Q-on-Q to 97.8 million ringgit. Okay, In terms of outlook, we expect sequential retail sales to remain seasonally soft due to the absence of festive period in the quarter 25, although this should be partially mitigated by the recently announced additional public holiday in September, on top of continuous government measures to support consumer spending. And beyond the immediate term, management is still guiding for mid-single-digit rental reversion, considering its robust tenant demand at both Mid-Valley Mega Mall and the Gardens Mall. We think that the strong bargaining power should enable the REIT to pass through the upcoming SST rate hike increase to their tenants. Meanwhile, the acquisition of South Key Mega Mall is expected to complete by fourth quarter 25, and this should drive meaningful inorganic growth while also allowing the REIT to tap into strong spending power from the Singaporean shoppers. Post-result, we maintain our earnings forecast and target price of 2 ringgit and 60 cents. Our target price imply a yield of 5.2%, which offer a spread of 180 bps over the Malaysian bond yield. We downgrade the stock to neutral as we believe the current yield spread is not attractive enough following the recent share price rally, and it has already priced in the inorganic growth prospect from the upcoming South Key Mega Mall acquisition. And also, their fully fixed rate debt structure limits any potential upside from the recent policy rate cut, unlike other REITs with higher floating rate exposure. Yeah, that's all for me. Stop here and see you guys again tomorrow. Thank you, everyone.